Okay. Hello? Are we live? Let's see. My microphone was on mute. So I want to make sure that that's working now. Microphone, it's on. I can't hear it on the other computer. Okay. Yep, I can. There's just a delay. So are we live? All right. Sorry guys for all the confusion. Let me mute this. Now I know that it's live. So I know the microphone is working. So for those that wasn't listening or want to watch it later or whatever, this is my very first live. I still testing all. I didn't want to test it anything on. I didn't want to test it anything on the unlisted. I want to test it publicly to make sure everything is working. So we're gonna have a bunch of errors during the day today on this first live stream, and we're looking to learn with that and then make it better on the next ones. So we are live for today, day trading. We're gonna do Nasdaq. Market market is about to open. It's at 9:23 right now a.m. on the East Coast, Florida. That's where I'm at. So market is gonna open in about seven minutes. So we're gonna take a quick look and see what's happening and wait the market open to see if we can find opportunities to make trades. All right, so let's go to the chart. Before that, let me just make sure everything is working here fine. I think everything is working correctly. So, all right, guys, just hit the like button, subscribe, and let's join the channel. Help me grow that channel, and let's see what we can do. All right. So let's go to the chart. This is not the chart we want. See, we already got the main monitor. Second monitor, it's not on that. Let me see if I can change that to not that. Sorry guys, we're gonna have a lot of confusions here until we find what's going on. There we go. That's the left monitor. Let me go to leave this in here. So let me rename that. I'm not gonna do all of that now. So 1 and 2. That's good for side. The market wants to go first at the opening, and then after that we'll go from there. Okay. At the meantime, let me do, I'm gonna leave this chart here. So this top one on the left, those are the higher time frames that I keep an eye on it. So this one is the S&P. As you can see it on the left upper corner. And then here is the dollar, the DXY. This one is the Nasdaq. And this one is the Bovespa Cash, the BR50, the mini index on Brazil. So I keep those on a higher time frame. I like to trade the Nasdaq and the mini index, the BR50 on Brazil. So those are mainly the two instruments that I trade, but I like to keep the S&P and the dollar also on my eyes and on a higher time frame. I usually keep this in between the 5-minute and the 15-minute. And on this chart here, I have the indicators I have is market just opened. So we're gonna wait a little bit anyway. So let me tell you real quick. So I like to keep this as an order block indicator that tells me the order blocks, the buys and sells order blocks on the chart on the respective time frame that I use. Moving averages are the same. Pivot point, same. And then I got the order flow on the right, which is the, let me close this, open. It's the VRVP. So I like to keep those indicators. So here I got this one hidden. It's a paid indicator that I have, but I only open this one usually when I'm doing swing trades. It gives me signals on buy and sell alerts and stuff. But I don't like to use it for the day trade. So order block detector for Lux Algo, the free one. Pivot points, the standard. SMAs and EMAs, I'll only use mainly the SMAs and the VRVP. So those are the mainly the indicators that I use for the high time frame on the multi-chart as you see here set up. So let's go back to the opening. All right. Opening right there, NASDAQ, it's open. It's just already crossed the all-time high. It crossed the pivot. It didn't cross the all-time high yet. Let's go back to the daily. Now, as you can see, the all-time high is right there. We got one more resistance before we reach that. Leave it on a 5-minute for now. And let's make sure we don't have any more news for now. Like to use the I use the trading view calendar, and I also use the investing.com economic calendar. So those are the two that I use. Usually the trading view tells me exactly what's going on. The trading view don't tell me the past ones. It only tells me what's coming. If I wanted to see anything that was past, and then I can look at that on the investing. So trading view this is what we got. We got 10 o'clock. We got couple news. We got Chair Powell speaking testimony the second day. He did yesterday and again today, and I believe tomorrow as well. So he's gonna testify at 10. He's gonna start it at 10, and then 10:30, 11:30 we got more news. Noon we got more news. 3 o'clock. So we got a lot of news for the afternoon, starting at 10 o'clock all day long. So let's pay attention on that. Let's go back to see what's the ranging's doing. So that's the 15-minute candle. We wanted to mark the high and the low, and we're just gonna wait for now. We can wait on the 2-minute. 5, make sure we got the highs and lows correctly. Make sure we got them right. All right, we'll leave there. 5-minute. So that's the range. We got the opening. Is this the opening? 918, 920, 922. Let's go 5 by 5. 925, 925, 930. So we can actually go that. So that's the 15-minute we're looking at. Let's wait and see what side is gonna break. Usually the side that it's breaking, it's the side that it's wants to acted for the rest of the day, but it can be a fake. So we just gotta pay attention on that. Just watching on that. to the upside. Go on 15. We have we already passed the order block that was there, a lot of volume, so that's it didn't close that order block. The sell-in order block still there. We're gonna mark one here. This area here, 3 candles. Set that as a default just as so we can see it. That's a pretty strong selling zone right there. All-time high. I'm gonna do this as just a bare order block, just a bare area, and I'm just gonna pay attention. We're gonna wait, see if the price goes look for liquidity there. Pretty strong opening, pretty strong rip to the upside. Just pay attention. We're not jumping in anything crazy. Stream. Oh, we don't have any background music playing. It looks like, let me take a look. Background music, properties. Oh, yeah. I hope that's not playing because that wasn't the one that I wanted to play. This one is the one. Okay, I think that's it. Now we have some background music playing. Let me double check. We're going to change. We're going to change it again, do this other one. Just wait. As you guys can see, we're doing a lot of arrows on with the stream, but we're gonna be learning as we go with the stream. Looks like it didn't change the background. We're still waiting, guys, because price went shoot up, look for liquidity, and it got back inside of the 15-minute range, the opening range. So we're still not doing anything. If it was to be scalping the opening, and then we could have get that, but I'm a seller below this point. Keep waiting. All right, let's wait that candle to close and see if we wanted to. That's fine if it goes. We'll gotta wait for a little more confirmation on that. Maybe it's just want to go look for liquidity. Seconds. point. So I'm gonna do there we go. I'm selling on trade, sell one. We could not figure this. Don't tell me that. My broker did not connect it. My broker is connected, but they don't want to let me place a trade in here. Oh, that sucks. That's fine. We are going to do is, so I did got a trade in this account. This is a eval account. So I entered down there on that. So I'm gonna mark, this is my entry. My stop, it's on the high of that candle. And I'm looking for this pivot point as a 2-to-1. The candle, it's pretty big, so my stop, it's gonna go just like right there. Alright, so that's our first trade of the day. I gotta figure why my broker didn't let me place the trade here. So the trade is still on. I kind of wanted to lower my stop. I don't want my stop, it's a little expensive now. I like to keep my stops pretty low. I only trade micros, so 1 micro at a time. And so on the micros, I like to keep like a $35 range for the stops. So right now on this one, we got a little double. We got like 70 bucks on the stop right there. So the best place for the stop, it's actually on top of that candle right there. That would be the optimal best place for the strategy, but we're pretty close right there. We should have just put there. As soon as we break it, we get to the slows, we'll break the slows, we'll get to the break even. That's a pretty high, I don't like that. I stopped out. All right, stopped on that. I'm gonna open to the trying to figure why my broker didn't let me place the order. Oh, I know why. I know why now. Because I should have been using this one instead of this is for the active trades. And I'm on the FXCM here, and this is the one. Too late. Yep. I was gonna try to buy it over here on this one. I'll stop. It's gonna go below here. My target's gonna go up there. And we're gonna go back to the 15 and just mark the areas in here because I don't have it. So we're gonna do really quick. It's yesterday, the high of yesterday. The low of yesterday. Opening. Okay, we got the levels marked. Back 2 minutes. Increase that. Alright, so that's the trade we got on. That was the mistake we was doing. I had a different broker. I have the right broker, but I had the wrong chart. So that's why. Since we enter late, we're not going to keep our stop here. We're going to do my stop a little lower. So if it takes me out here, that's fine. Doing that because made a lower low, so if that breaks, I think I'm kind of still in a short bias. I just kind of did FOMO on that. Let's wait. I'll leave that one. We're already in the trade. Alright, I like that. I like the buying. Like that buying power that showed around the moving average. I like that. Good rejection. So we don't want it to go back down. No. We want it to go up. We don't want it to go back down. We want to make sure to get high if no, and then they might want to come test the 50. It looks a strong market. See if it keeps going up. I don't like that third rejection right there. We'll keep in the trade. Where's the shorts coming? Rejection again. I almost stopped out and it went back up. Very strong rejection here, so let's see what happens. We need to break this trend line to show the sellers that the buyers are in power. Breaking that, it's probably gonna, if it breaks that, it's gonna spike because it got a lot of stops over there. A rejection again, a trend line, so we wanted to rip that. There we go, stronger. Kill this stops, kill that, kill that, kill once. Let's just rip stronger. All right, more stops killed. One more set of stops. I'm gonna put it on a break and just let it play because it's playing too much here. There we go, that's the rip. I'm gonna take profits on that one since I already. I'm gonna take at least 3. So I booked 3, left 2. Be right back. Let's see if we got back. Still want to trade? You can leave it stop there for now. here now. If I get taken off here, I'll probably looking to buy back here again. Alright, we got out on that trade. Let's wait and see what's gonna happen. It's probably just gonna take us out and rip it, but that's fine. No rush. I'll be right back. All right, we're back. I see the market very strong today. ES is approaching the all-time high, so gotta be careful now. Let's see how far. Nine points. That's another 20 points for NASDAQ. Is that right? Somewhere right there. So not much room to play. Better wait a little bit and see what's gonna happen. Alright, we'll just keep waiting. Waiting for the either a pullback or the best entry so far is this one over here. Stop at the low, and then but we only got to 1-to-1 right now, but it's so far the best entry. We did got it stopped out. We enter here, we got stopped out somewhere here. And then we, as of right now, we getting close to, we did a partial, so, and we didn't hold it all the way to the top, so we still on red. We didn't recoup the loss yet, but that's fine. We'll wait for the next opportunity. Very strong market, so it's going to be hard to find interest. Very strong market overall. Nasdaq, it's 1% up. The Russell's 78%, 70%. Dow Jones about 40%. S&P about 80%. So as you can see, it market, it's pretty strong overall. See all the news, what we got going on coming. Fed master speech in 1 hour, 4-week bill auction, 8-week bill auction, well, all in 1 hour, and then noon we got more news. Dollar selling off pretty hard. That's keeping the market even more strong. Dollar's just selling off pretty hard, so that's why if that breaks, what's the downside? Well, yeah, it's still quite a bit, so we can look for the next pivot point, this area over here. So you can look for that. That's about it's 1/4% all the way down, which is one more candle pretty much. This candle itself got 30.31%. So one more candle will flush it to that point. Then probably the dollar is going to react or just stay there, and the market could maybe do a pullback. So gotta wait and see it. There's nothing to do. Trying to force entries now would be just shoot on the foot. So it's very difficult. So I'm just gonna wait a little. Let's do something. See how the market from London session. It's a straight shot all the way up. One small pullback here during between 6 and 9 o'clock, and then he ripped more. market's still looking to what it wants to go up. Oh, let me do. If it stops there, the golden pocket, it's all the way back to the 200 on a 15-minute, which is the opening. If it stops, but it's not going to change much anyway. Even if it goes to right there, so still on the same range, right there. So. It's just ripping. Be right back. All right, we're back. You is that what's that? Is that oh, that's the next pivot. The all-time high is. We don't have the all-time high here on this chart. We did it on the other one, so let's put it on. Let's do. I'm gonna do this text. What? All-time high. right, and we're gonna save that, save as all-time high. That way we always have that. Okay. NASDAQ, S&P is very close to the, that's not a, let me look at it, hold on. S&P, let's go to the S&P. I think I was looking at wrong at S&P, that's why the pivot point's kind of confused. So let's go day, oh, that was the all-time high. Yeah, so we did pad, that was, I wasn't, what did it over here? Look at this. What's, oh, that was my swing trade got triggered to the profit, to the target. So I got out on that swing of my swing trade. Okay. So let's go. This is the S&P, right? Daily. What we're gonna do, that we're gonna just mark this one for now. All-time high, and we'll move it as we need, because by the end of the session. Because it keeps eating the all-time high. I don't like indicators that put that, because I like to do manually, because that way I know it's not like the indicator telling me where is that. I really get to know, I get to do it. The only basically lines on the chart that I kind of like it, except for the moving averages, is the pivot point, which it helps me with the supports and resistance. So guys, hit the like button, subscribe, and down in the descriptions we got links for referrals for Apex and Bolinox and KuCoin. So help yourself, and if any of those links will help you achieve your goals, just use them. That kind of give us a little revenue, and it helps the channel. Thank you. we got nothing going on. Alright, got a little sell going on. Let's see what's gonna happen in there. So we got our book here on 2 minutes, and we got our block here on 2 minutes as well. Let's see, 5 minutes. We don't have much, but those are the areas with a lot of volume. And the 15-minute. 15 minutes, a big sell block over here. So that kind of goes in conjunction with that. 1 hour, nothing. So watching to see and guys, for those that are watching from, I will watch this from another place. I do speak Portuguese and Spanish as well, so you can type in the chat in either Portuguese or Spanish, and I'm a Brazilian, so I can communicate on English, Portuguese, and Spanish. So if you guys wanted to chat, that's any language, it's fine. I don't want any other of those three will be fine. Put those as a blue area, that's why. They know the order block, so order block blue, yeah, there's a line already in the middle. Order block blue, alright. What's the risk to reward here? Stop there. Here, 167, that's reasonable. This one, almost 3, that's good. And then the stop will be lower anyway. That's the regional. So maybe we'll play this. Let's see. Kind of want to play this with a short stop just to get this pullback and then maybe buy it over here. Let's give it a little, let's see if it gives us a little nice entry candle here like this one. see. A lot of buying pressure. NASDAQ, it's kind of falling a little. That might help. Holding on. Holding on this high. Let me look at it. If Paul is speaking. Still.
Even more treasury bond risk, and that of course would have maybe hastened the collapse
Paul
of
is
SVB.
still
And I guess I want to start here with, when we talk about
testifying.
some of the
That's
Basel
why the market,
regulations.
it's kind of.
What was the original intent? In other words, what was the original sort of proposal for which banks would fall under those regulations and which would escape them?
You mean this time around, or I mean earlier on?
This time around.
So it's the 37 largest banks. It's down to, well, there's 4 categories of banks, including the G-SIBs, and this is down through the 4th category. The original proposal that's out there now, I think, does extend to category 4 as well as 3, 2, and 1.
So what's the minimum assets under management that you guys have proposed, the current
billion.
Basel regulations?
100 billion.
100 billion. And sort of that sort of gets to my concern here, because I know there's some discussion about whether you'd apply them at $700 billion of AUM or $100 billion of AUM. And maybe you could just sort of walk me through that decision process at the Fed, where you guys are, and what would sort of justify drawing down from a $700 billion threshold to a $100 billion threshold.
So there's the G-SIBs, there's the 8 identified G-SIBs, and then there's one category too, I guess, and then there are the big regionals, and those tend to be well-known big regional banks, and they're category 3, and one of them's a 2, I guess, but they have a different tailored level of regulation. And category 4 had significant tailoring. And the question is, we have to ask the question, since SVB was a category 4, we've got to ask the question, what if anything needs to be changed in the way they were regulated
That's live on
supervised
the
from a capital
CNBC. I'm
liquidity
gonna post a link on the
standpoint.
chat.
There was tailoring all the way down, and then below 100, of course, those are community banks, and that's a different regime as well. This makes sense. We want to have, we want to have a diverse banking sector. That's a great benefit to our country, and very unusual for an advanced economy. So it's something we want to preserve.
Yeah, and I'm sure you know, Chairman Powell, but just to put this on the record, I mean, a lot of the commercial lending, a lot of the real estate lending, a lot of the consumer lending, about half of that lending, consumer lending, is provided by the regional banks. I believe Huntington, in my home state of Columbus, is the #1 SBA lender in the entire country. So these, to your point, I think these do provide incredibly important benefits to our economy. And you hear a lot of people talk about the American economic miracle, and I do wonder if part of that is because we don't have the same type of financial system that has sort of dominated in Western Europe and in other first world economies. I'm curious, in the process of amending the Basel requirements, have you guys made a decision about where to set the threshold yet, and when do you expect to set that threshold?
We haven't made any final decisions. We put out for proposals some
Right.
months ago, a proposal, and we've gotten a lot of comments, as I'm sure you're aware. We're chewing through those and digesting them, and we're just beginning now to sit down and talk about the changes that we'll appropriately make to the original proposal.
And when do you expect to sort of issue a final proposal?
I think it's going to take some time. I think it's more important to do it right than it is to do it fast. My guess is we'll get through this and be done over the course of this year. But
Okay.
it could be faster than that. It could be slower than that.
So
Yeah,
I'm wondering, just
politics and then the
being
market
mindful of
kinda
time, I have about
moves
30
up a little.
seconds left.
But the
Would
other
you be
one
willing
speaks
to
and then the
commit
markets goes down.
to say that in the process of amending, the Fed will remove the regional bank drawdown and limit Basel's application directly to the G-SIBs or $700 billion or above?
I can't get that specific at this point, but we're clearly looking at the whole tailoring issue.
I appreciate that. And again, I just repeat, Chairman Powell, given what actually happened with the banking sector with SVB and First Republic, I just encourage you guys not to apply a regulation that doesn't actually solve the underlying problem. And I fear that if you apply this to banks of $100 billion and above, you actually are doing just that. So with that in mind, I'll yield. Thanks, Mr. Chair.
Thanks, Senator Vance. Senator Tester of Montana is recognized.
Yeah, thank you, Chairman Brown, and thank you for being here, Chair Powell. We appreciate your work in a difficult situation, but I think you've done a really good job, and so thank you for that. Look, at success at the Fed on your mandate for strong employment and stable prices is critical for small businesses on Main Street, for farmers, for ranchers, for Montana families. You follow all the metrics. From your perspective, where is the economy at now, and where's it going?
The economy's growing at a healthy, sustainable, solid, strong pace, and that's one thing. Second thing I'd say is the labor market is very strong and quite tight still. 3.7% unemployment for the
Waiting
last
on, we
24
didn't
months.
enter
That's the
anything.
longest period since 50 years. And the third thing is inflation. Inflation was too high. It's come down very sharply since the beginning of last year. If you look at the 12-month number, the headline number has come down from the 5s down to 2.4. And the core number is at 2.8. I think it was at 4.9 a year ago. So these are big declines. So we're in a very different place, in a healthy place. We're going to use our tools to try to keep that strong economy, keep that strong labor market, while we continue to make progress on inflation.
One of the areas where there has been inflation, and I don't exactly know where it's at now, but food rose quite rapidly. And by the way, I'm a farmer. We didn't get much of that. In fact, we didn't get any of it. Prices now, compared to what they were a year ago, are actually off. Compared to where they're 6 years ago, they're up. But compared to where they were a year ago, they're down. And so my question to you, Chairman Powell, is there anything you can do specifically to deal with food costs?
So as
Fed.
I'm telling a farmer his business, but if you look at the food cost to the consumer, part of that is commodity costs, and that was partly spiked because of Ukraine, grains and oil and that kind of thing. But the rest of it is a lot of costs in the supply chain, from when it leaves the farm to get collected and processed and trucked around and then put on the shelves and then the stores. All of those costs are just part of the general economy. So as the labor market cools off, from its overheated status 2 years ago, you will see, and we have seen,
Market just
you know,
wanna
food
rip.
inflation flattening out. And so, you know, the really high rates of inflation have come down. The prices, of course, have not.
Correct. I would just say that cattle's doing better. Grain actually has dropped in price at the farm gate, and I don't want to get into that debate with you at all because we probably agree, but it'd take too long, take too much time. We got other stuff to talk about.
I'd be learning from you.
You've discussed in previous hearings the impacts that the pandemic, shutdowns and supply chain issues have had on economies globally. How does the U.S. economy look today compared to our competitor nations, particularly China?
Well, I start with the advanced economies. You know, we're doing the best of anybody. We've got the strongest growth and the lowest inflation of the advanced economies. China is a whole different story. China is having, you know, significant difficulties with its economy right now, and they're in a very different place than certainly than we are.
And so, to repeat that, what I heard you say is that the economy of the United States is basically in better shape than any other economy in the world?
Any other major economy? Yes.
Yes, okay. Look, one of the other challenges out there is housing in communities all across this country, whether you're in Montana, whether you're in a city in Ohio. Workforce housing in particular is a top priority, top commodity, so to speak. Plenty of folks, great organizations are working to address this. I meet them every day and I appreciate the work they're doing. But how do these housing supplies issues show up in the data that the FOMC uses to make decisions?
So housing prices don't go into the data. Housing starts and renovations and things like that are just business activity, and that shows up. But when it comes to inflation, we convert ownership into an imputed rent, and then we look at rents. Okay. And so that's how we look at all that. So we're not directly affected by changes in housing prices, but over time those will drive rents up.
So is it fair to ask, are there economic trends that you see for housing?
Yes, so there's two big things going on. One is we have this underlying shortage of housing, and it's due to things like difficulties of zoning. A lot of the close in to cities, places are already built, and so more difficult to get zoning, more difficult to get people and materials and all that. That's one thing, and that's not going away. Then there's just a ton of things happening because of the pandemic, because of inflation, because of higher rates. And those are, in the short term, those have they're weighing on the housing market. But as rates come down and that all goes through the economy, we're still going to be back to a place where we don't have enough housing.
Once again, thank you, Chairman Powell, for your work. I very much appreciate it. Thank you, Chairman Powell.
Thanks, Senator Tester. Senator Kramer of North Dakota.
Thank you, Mr. Chairman. Chairman Powell, good to see you. Thank you for being here. It's been a rather uneventful couple of days for you, considering you've spent 2 days in this place. And I'm not going to upset that, just so you know. But I did appreciate your response earlier to Senator Scott when he asked about immigration, and you said the Fed hasn't been assigned that. So I want to bring up something else you haven't been assigned to that you and I have talked about over the years, and that, of course, is climate, the role of climate in your job, the role of climate risk in banking. And you've often said, I think the most common statement was, we should stick to our knitting, I think is one of yours, stay in our lane, similar to what you said probably to Senator Scott. But that said, in October, the Fed, the OCC, the FDIC issued climate guidance, as you know, for management of covered institutions. And so I'm just kind of curious, did Congress somewhere along the line give the Fed authority over climate policy as well, or is that another one of those things that somebody just took on? And I realize you're not the dictator of the Fed, only the chairman of the Fed, but I'd be interested in, as the chairman, your views on it.
Just watching and see what's
our
going
assignment
on.
is the safety and soundness of banks, and that they understand and can manage the risks that they face. That's our assignment. And we said in climate world we would do two and only two things. One of them was to do illustrative stress scenarios. Mm-hmm. Scenarios, not stress scenarios, climate scenarios, so that, the banks are already doing this. The large banks who are subject to this, they're already doing it because they're doing business internationally and they don't have any choice. So we said we'd do that, and we also said that we'd offer guidance on,
see if
not,
that-
not on level of climate
that
risk or
worked.
anything like that, just
That,
on what you had to do
forming-
to be in a position to assess.
Forming
And,
a low,
that's,
low
from my
choice.
thinking, that's it. That's what we're doing. And we're not doing it, there are no new initiatives. We're not going to change our capital requirements to reflect climate risk or anything like that. I'm really determined that we are not a climate policymaker and that is really the business of elected officials.
Very good, thank you. I'm going to bring up one other topic I don't know that's been brought up today, and that's central bank digital currency. I think from a lot of my friends out there, I think there's some, well, I know there's some confusion. I mean, I'm easy to confuse, but there are a lot of people that get confused about what is meant
higher
by
time
the
frames, look.
administration's, admonition to continue researching, experimenting, looking at some sort of central bank digital currency. I think people
Pretty far
back
from
home look at
moving
that and go, oh my
averages.
gosh, they're going to
I
control
wouldn't
this now.
surprise me if you get a pullback to
And
that-
could you maybe
to that
just
one.
differentiate a little bit what people think of in
1
terms of
hour,
a
still.
Bitcoin or their held
1
digital
hour would
currencies
actually be
versus what a
strong.
central bank digital currency,
Very,
who,
very
in my
bullish.
view, should emulate cash, right? It still should be about the dollar, not about some different kind of currency.
Pullback
Could you
will
just sort of
do
help
anything. We'll do
people back
nothing on the
home
1
better
hour.
understand
I
why they
can
shouldn't
try.
be quite so frightened?
First of all, I want to say that we're nowhere near recommending or let alone adopting a central bank digital currency in any form. But the idea is that as technology has evolved, money has become digital. So, but the government doesn't issue digital money. It's digital. If you look at your bank account, people don't hold those physical dollars. So the thought was that the government could create a digital form of money that people could then transfer among themselves. Now, of course, that raises a concern that if that were a government account, that the government would see all your transactions, and that's just something we would not stand for or do or propose here in the United States. That is how it works in China, for example. But that's not what if we were to ever to do something like this, and we're a very long way from even thinking about it, we would do this through the banking system. The last thing we would want, we the Federal Reserve would want, would be to have individual accounts for all Americans, or any Americans for that matter. Only banks have accounts at the Fed. And that's the way we're going to keep it. So it's just really, it's a question of following technology as it evolves and in a way that serves the public better. People don't need to worry about a central bank digital currency. Nothing like that is remotely
like
close
that.
to happening.
Very helpful, thank you.
See if we
Mr.
get a
Thank you, Chairman.
Remember, Senator Cortez Masto of Nevada is right.
Thank you, Mr. Chairman. Chairman Powell, great to see you again. Thank you for all of your good work. I want to talk a little bit about the commercial real estate and what's happening there. The Financial Stability Oversight Council's 2023 annual report identified commercial real estate as a financial risk. And the Fed's monetary report also noted commercial real estate prices continue to decline, especially in the office, retail, and multifamily sectors. I'm especially concerned that because of the low levels of transactions in the office sector, prices have not yet fully reflected the true decline in the value. So can you expand on the emerging risks the Federal
Give
Reserve
us a
has
little-
identified in the commercial real estate market, one? And then I'm curious, can you discuss the
Sell for a
compound
pullback.
risks identified in commercial real estate lending, particularly at banks with large CRE concentrations and high fractions of uninsured deposits?
Sure. Let me see. I think there are just very, very few transactions in commercial real estate right now, particularly in the troubled areas. So it's not a question of prices still falling. It's a question that you don't have the kind of price discovery. You just have to assume that the prices are very low and have come down a lot. So on commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made
Yeah,
loans
of
to many
course,
of
they
those
want to go
buildings.
up. They don't want to go
Not
down.
all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them. And so for some time we've been doing that. And this is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks. If you look at the very big banks, it's not a first order issue for any of the very large banks. It's more, smaller and medium-sized banks that have these issues. We're working with them. We're getting through it. I think it's manageable is the word I would use, but it's a very active thing for us and the other regulators, and it will be for some time.
Thank you. Do you have concerns, let me just ask you this. As you're
Holding that
talking
trend
with these
line, but it's
small
very
and
tight.
medium-sized banks, because we know there's always could be a contagion.
Need something
which we've
below
seen in the
this.
past. Do you have concerns that if they fail, that somehow this is going to impact the financial sector? And are you prepared and trying to address that and
They
prevent
don't
that
want
from
that to
happening?
happen.
We're trying to stay ahead of that. So we also reached out to banks that had high concentrations of uninsured deposits, and particularly uninsured deposits, and a lot of commercial real estate in the office sector. So we're well aware of that issue, and we're just trying to stay ahead of it on a bank-by-bank basis and overall.
Okay.
And so far, we've been able to do that.
Thank you. Let me jump to another issue that has been on my radar. The Federal Housing Finance Agency's report on the federal home loan banks concluded that the distinction between the FHL bank's role and that of the Federal Reserve discount window as lender of last resort has not been clear, especially during times of market stress. During the 2023 banking turmoil, we saw banks rely on advances from the federal home loan banks and didn't even have relationships with the Federal Reserve to use its discount window. I know you've talked a little bit about this with Senator Warner, but how is the Federal Reserve working with the federal home loan banks to ensure that banks establish protocols to borrow from the Fed's discount window prior to times of stress?
We work with the federal home loan banks because in many cases, banks were moving their loan from the Federal Home Loan Bank to the Fed. So we need to have smooth transfer. We need to be in good touch
Very
with
strong
them.
market.
Even more
It's
important
holding
than that, though,
very, very
is
strong over
that
here in
banks,
this area.
any bank in the United States needs to be in touch with the discount window, know how to be able to access it, be able to access it, have appropriate collateral, have control of that collateral. In many cases, it was incredibly inefficient and took a long time for banks to actually go through that function. The federal home loan banks are actually ahead of us in technology. We know that we need to really invest in technology to modernize the discount window, and also we need to do more to get our banks, all of them, in touch with the discount window in a way that they can use it quickly should they need to do so.
Thank you.
Cortez Masto, Senator Haggerty of Tennessee is recognized.
Thank you, Chairman Brown. Welcome, Chairman Powell.
1 minute. Sellers are stepping in.
Under your
which is
tenure,
not
Mr.
enough.
Chairman, the Fed has taken the stance that the 2% inflation target shouldn't be viewed as a snapshot in time, but rather it needs to be achieved, quote, sustainably. When inflation was running well above the 2% target back in 2021 and early 2022, the Fed was patient and allowed rates to offset the below target inflation that had occurred in the years prior. It strikes me as odd now that while we're still well above target inflation and have been well above for the prior year, markets seem to expect the Fed to immediately cut even before we've reached the 2% inflation threshold. So my question is this: if the inflation rate reaches 2%, would that be considered a return to the target rate on a sustainable basis? Or is it still the case that inflation would need to more or less overcorrect to well below 2% before the Fed makes the rate cut adjustments?
It would take us a while to really get comfortable that inflation had settled in sustainably at 2%. But that's not our
Just
test
eating
for
all the stops.
changing interest rates. Interest rates right now are well into restrictive territory. They're well above neutral. And we've said we would not wait for inflation to get down to 2% because if you wait that, monetary policy works with long variable lags. So we've said, for some years that we would start restoring the federal funds rate to a more normal, almost neutral level. We're far from neutral now.
Yeah.
And so, we do plan, assuming the economy moves along the lines we expect, we do plan on on starting the process of dialing back restrictions.
I'm just trying to look for the symmetry. I know we sort of allowed the economy to overshoot when inflation was high, and we sort of made up for prior years of low inflation. I'm trying to square that with the fact that
We didn't actually do that. We adopted a framework that said we would do that, but then we got suddenly, a few months later, we got almost an explosion of very high inflation. That's not what we were looking. We said, you know, moderately above or modestly above 2%. This was not modestly above 2%.
Very, very
we
strong.
Reacted.
Let's
We
see
thought
what
that
happens here.
the mistake we made was we thought that inflation would go away.
that it was transitory.
Transitory, which means it goes away
Scope
quickly
for now.
without effort by us. We figured out at the end of 21 that was not the case, and we acted.
And you don't see that same abrupt dynamic coming the other way. You're more comfortable.
No, I think we're in the right place, which is we're waiting to become more confident that inflation is moving sustainably at 2%. When we do get that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction so that we don't, drive the economy into recession rather than normalizing policy as the economy gets back to normal.
Yeah. Can we go to the balance sheet and talk about that? We've seen a dramatic expansion of the Fed's balance sheet over the past couple of decades. In 2005, it was at $800 billion. It's at $7.5 trillion a day. It's doubled since the pandemic was underway. And through quantitative tapering, the Fed is attempting to reduce its footprint. And
If absorbs or not.
the concern I have is, on the other hand, government spending tends to just continue to be profligate. We're running now a $1 trillion deficit every 100 days. And we're flooding the market with Treasury debt, and we're putting upward pressure on interest rates as a result. And what I think that's lost on many of us here is that the spending levels will only make your job harder when it comes to lowering interest rates, not to mention there's a tacit expectation that the Fed will step in once the markets can no longer absorb our new issuance. I think this is a very serious problem. I think it deserves more attention. And I think we're now at a point where your objectives may be very much at odds with the behavior of our fiscal policy. Am I missing something here, Mr. Chairman, or does increased net issuance by the Treasury lead to higher rates?
I mean, in principle, more supply should lead to modestly higher rates, but that's not going to affect what we do. That's not a problem for us. Our balance sheet normalization is running very much as expected. We've decreased the size of our holdings by almost $1.5 trillion.
I hear you. I think it's troubling that we continue to put fiscal pressure by continuing to put, again, we're running a deficit of $1 trillion every 100 days. The issuance is required to deal with that. We're putting a lot more pressure, I think, on the Fed. And again, making your job harder. I think we need to take that into consideration. Another component of this topic, your colleague Governor Waller said he'd like the Fed to shift its holdings toward a larger share of short-term treasuries. Back prior to the financial crisis, about a third of the Fed's holdings were in bills. Now they're around 3% of your total securities holdings. Do you share the goal with Governor Waller? And if so, how long will it take us to get there?
Take a while. That's an issue. We're in our FOMC meeting in a couple of weeks. We're going to have our first really deep dive on what to do with the balance sheet. That's one of the issues. I don't think we'll deal with that at this meeting, but over time, you'd love not to own a lot of MBS, and I could see a case for shortening the maturity, but it's not something that would happen quickly, and we're not actively looking at that. That's sort of a longer term aspiration that I think he was.
Just one final point, Mr. Chair, and you and I have talked about this before. We're in an election year. You're getting a lot of pressure. I hear it from lawmakers to adjust rates. I'm not telling you to raise rates or lower rates, but I'm just here to emphasize the fact that the credibility of the Fed depends on your remaining data-driven. The credibility of our currency as the reserve currency of the world depends on that, and I encourage you to continue to maintain that posture. Thank you.
Will do.
Thanks, Senator Haggard. Senator Warren of Massachusetts.
Thank you, Mr. Chairman. So it's been a year since we had the second, third, and fourth largest bank failures in American history. Greedy bank executives were part of the problem, and the Fed, as the chief regulator of the biggest banks, was part of the problem. Under your leadership and direction, the Fed steadily weakened rules for the biggest billionaire banks, exactly the banks that failed last March. In other words, Chair Powell, you failed to do your job to keep these big banks in line. Now, when these banks blew up, you went into spin mode, promising that the Fed would do better. After years of hemming and hawing, you finally agreed to put in place Basel III rules that would strengthen capital standards for the biggest banks. And I mean the biggest banks. These are the Fed's proposed rule would apply to only 37 of the nation's 4,500 banks, only the banks that have $100 billion or more in capital. Now, Chair Powell, when you testified before this committee last year, I asked you about taking responsibility for bank failures. And you said, quote, "The main responsibility I take is to learn the right lessons from this and to undertake to address them so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system," end quote. And as part of learning those lessons, you also said, quote, that you agree with and support, end quote, Vice Chair for Supervision Barr's recommendations for strengthening the Fed's rules and supervisory practices for the big banks, and that you're, quote, confident they will lead to a stronger and more resilient banking system, end quote. So I just want to be clear. You haven't backed down from any of your comments from a year ago, have you, Chair Powell? Right lessons, don't let this happen again, supporting Vice Chair Barr's recommendations, which include stronger capital standards.
No.
You still stand by all that?
Yeah.
Good, good. I'm glad to hear that. Now, I understand that those 37 big banks don't like higher capital rules because they are like insurance. You know, they would make the banks safer, but they cost a little money and would nip into the bank's profits. So these 37 banks are swinging their very considerable weight around to try to weaken the capital rules. They've spent tens of millions of dollars running ads during Sunday night football and millions more for an army of lobbyists to try to twist arms here in Congress. Impressive spending, but who exactly are they trying to impress? A man on the inside? You know, despite all you said last year when the banks failed about supporting Vice Chair Barr's recommendations to strengthen rules for big banks, public reporting now says that you are driving efforts inside the Fed to weaken the capital rule. You even told the House Financial Services Committee representatives yesterday that you think it's, quote, very plausible, close quote, that you withdraw the rule. As one analyst put it, quote, "I don't think they will pass a final rule without Powell's support," suggesting that the rules will have to be weakened, quote, to appease Powell. So, Chair Powell, I'm having trouble reconciling the statements you made last year, which you say you hold on to, statements you made when the headlines were all about 3 giant bank failures, and now your reported efforts to quietly weaken the rules that would strengthen capital standards for giant banks and prevent more bank failures. So let me just give you a chance to clarify the record here. Are you committed to finalizing the strongest version of the Basel III capital rules this year?
Let me first say that we have taken and are taking many more steps to deal with the problems that revealed themselves with Silicon Valley Bank, and that's around supervision. We'll have a strong liquidity.
I appreciate that, but I'm just asking about the Basel III rules, the ones that you have been required for years now to put in place and have dragged your feet on.
The Basel III rules are not directly related. They're not the thing that is directly related to Silicon Valley Bank. As you point out, they're a longer run thing, and I would just say that we put them out for comment. We got the comments. Anybody's free to go read the comments. My view is that it will be appropriate to make material and broad changes to that before we finalize it. And in terms of, I didn't say that...
Material and broad changes to strengthen the rules?
Material and broad changes, and we're talking about what that'll mean in the end. I did not say that we would withdraw the rule. I said, there's a concept of reproposal, and I said we hadn't made a decision on that, but that if that turns out to be appropriate in the view of the Board of Governors, then that's something we would look at doing.
So everything you said a year ago about supporting the vice chair who is responsible for writing these rules,
You and I had a long colloquy.
Yes,
For a
we did.
pullback
If you read
to
it
this
again, it's on your
area,
And I
website,
have.
you will see
take the short
that I'm doing
through there.
exactly what I said
Then
I
I
would
wanted
do.
to see
in
No,
the
you
colloquy.
said
if I
you
buy
would
it there.
support Vice Chair Barr to get us
there we go,
strong
that's a
rules,
pullback.
and now he is putting
No,
out rules,
that
and
was
you're
about
talking
Silicon
about
Valley Bank.
proposing.
The Vice Chair for Supervision has every right to bring proposals to the board. That has happened, but as I made clear in our colloquy, you're not the comptroller of the currency. When I do monetary policy, I have one vote. There are 11 other voters, and that's the way it works. It's not different for the Vice Chair for Supervision.
You are the leader of the Fed, and when the heat was on last year, you talked a lot about getting tougher on the banks, but now the giant banks are unhappy about that, and you've gone weak-kneed on this. The American people need a leader at the Fed who has the courage to stand up to these banks and protect our financial system. Thank you, Mr. Chairman.
Warren, Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here. Good to see you. I can tell you Montanans are continuing to see the impacts across the board from inflation that's been brought on by the policies of this administration and by my colleagues across the aisle. And I commend you for
It's
the
not
job
letting me get,
you have done
limit.
in trying to rein in inflation, and I encourage you to continue the fight despite political pressures you may face. Last time I checked, it's going to get a little more political around here between now and November. I'm also encouraged, contrary perhaps to my colleague from Massachusetts, I'm encouraged by your comments yesterday that there will be broad changes to the Basel III proposal, which, as it's currently proposed, would have significant detrimental impacts to credit cost and availability to small businesses. And lastly, I commend your answer yesterday
Oh, look at that
that the
again.
Fed is not a climate
Just too
agency.
strong to short.
And considering the impact of climate change is not a factor in achieving your given mandate, congressional mandate, of maximum employment and stable prices. Mr. Chairman, I recently joined many of my colleagues in writing to you about my concerns about the long-term debt proposal that would mandate regional banks issue new long-term debt. I'm concerned that this will have a disproportionate impact on smaller regional banks because they're required to hold their long-term debt at both the parent holding company and insured depository bank levels. Could you explain how this aligns with the tailoring requirements set forth in the financial reform bill that we passed back in 2018, Senate Bill 2155?
So I have a longer-term debt proposal along with that. So, first of all, that's been out for comment. On that one, the comments are in. We're reviewing it. So I don't want to say too much, but the theory of it in the first place was that those banks are not subject to the living will process to the extent that the G-SIBs are. And this was sort of meant to be a middle step to make them more
rip in.
resolvable without
just to see
imposing
if it's
all
gonna
of the
work.
burdens that we impose on
Yeah, it
the
did.
G-SIBs to have very elaborate resolution plans. So that was the thinking. I think on
Oh, he
the
did mark it.
calibration of
Son
it
of
and
a
all
gun.
that, we have voluminous comments. We're looking at them, and we'll make an assessment and
Well, mark
move
it,
forward
dude.
as appropriate.
Well, thank you, and I know
What about
our
limit?
smaller regional kind of banks would be happy to hear that thoughtful
Great limit.
deliberation, Mr. Chairman. Understandably, you've had to raise interest rates to fight the fires of inflation brought on by reckless Democrat spending. However, a major side effect of that is the impact the rising rates are having on the cost of servicing the out-of-control national debt. Senator Haggerty alluded to this a bit in his questioning minutes ago.
Want to see if it's going to
Looking at
create
CBO, reports interest payments on our debt will increase 32% this year and will now exceed spending for the entire Defense Department. I have significant concerns, many do here in
Yeah,
Washington,
it's
many
creating
Americans do,
now.
that we
Why
eventually
wasn't
reach a
before?
point where fiscal policy and monetary policy converge,
answer
meaning
those
that the Fed would ultimately have to worry about the impact rate setting would have on government debt or even potentially the risk of a default. Chairman Powell, I know fiscal policy is not in your purview, but could you ever foresee a situation where fiscal irresponsibility snowballs to a point that the Fed would have to factor this into its decision making?
I think we're a long way from that, and that's a real, that's a terrible place to be. That's a place where some poor emerging market countries have found themselves over the years. For the United States to get to that point, I think it's unlikely, but I do think that, and it's not our business, we should stay out of this fiscal business, but I'll say what other Fed chairs have said, which is we really need to get back to that discussion about fiscal sustainability, and both sides need to get together. The kinds of things that have to happen can only be done on a bipartisan basis. And so I really hope that we go back to a place where those discussions are happening again.
I've heard from a number of stakeholders about upcoming changes to liquidity regs, including a new ultra-short-term liquidity requirement. As with any policy decision, establishing the facts matters. It's important that financial regulators have a complete, thorough understanding of the financial environment before releasing a half-baked proposal, rule, or guidance. My question is, what do you believe is a sufficient time period that would allow your agency to accurately calibrate new sound and reasonable liquidity requirements?
That is a great question, and one we're struggling with, particularly with all the other things that are going on. We're looking at some, and this isn't a response to Silicon Valley Bank. We're looking at some liquidity innovations, and we're asking ourselves, which form should that take, and how long should it be out for comment, and that sort of thing. We're not ready to do that yet, but that's the question we're asking.
Follow-on question, and I'm finished, Mr. Chairman. Will you confirm that prior to the Federal Reserve issuing any new liquidity requirements, it will first conduct all necessary data collection that would allow for meaningful analysis of all potential policy options?
And please keep your answer short, Mr. Chairman.
Maybe. No,
That's very short. Thank you.
I can't, we can talk about this more, but I don't want to make a really specific commitment like that without talking to people who are carefully in touch with this, but that is the right thought.
Thanks, Chairman.
Thank you. Senator Fetterman from Pennsylvania is recognized. Well, he got here last.
No.
So, although if Senator Warnock sits down in the next 5 seconds, he's next. So, Senator Warnock, are you ready, or you want to go to War 5? You're all so generous with each other. It's Senator Fetterman's recognized. All right. Senator Warnock is recognized from Georgia.
Thank you very much, Mr. Chairman. Bank spending on buybacks is rising again, and their consumer small has sharply increased. Interest rates are high, yet the interest being paid to depositors, ordinary working families, working people with bank accounts. Not a lot of money in Wall Street accounts, remains low. Chairman Powell, I'm concerned that when banks don't increase the interest rates on bank accounts, families are losing out on dollars that could be in their pockets. Again, they don't have the kinds of portfolios that some of the folks in this room would have. Is that good for the economy, and are you concerned that banks under your supervision are doing this?
Are not paying sufficient.
That's correct.
That's a question I haven't heard. Of course, they have the option of putting their money in money market funds, and banks compete with each other. But I'll be happy to look into that. I hadn't heard that concern.
Yeah, and I think it is worth taking a look at. Many lower income individuals and families, again, they don't have some of the sophisticated products yet. Money markets are available, but we saw high interest rates and that not being reflected in what depositors are able to benefit from. Could those individuals and families benefit from a high interest rate on their deposits?
Sure. And it's for a long time, we had a lot of mail from people at the Fed to the Fed saying, you should raise interest rates because we're not getting anything on our checking accounts. So we solved that problem.
I don't think we're asking for that, but given the reality, the question. Yeah. So let me pivot. The monetary policy report states that while demand for housing has fallen. A strong labor market has kept prices high. That matches what I've been seeing in Georgia. Too many folks can't afford a home. According to the Monetary Policy Report, mortgage rates were averaging around 7% last month. That's tough for lower income home buyers. Increases of just a percentage point or two can be the difference between owning a home or not. Are you concerned about this interplay between lower demand yet stubbornly high prices and what it means for folks trying to buy a home? And what do you think is driving these high prices?
So the housing market is in a very challenging situation right now. You have this longer run housing shortage, but at the same time, you've got a bunch of things that have to do with the pandemic and the inflation and our response with higher rates. So you have a shortage of homes available for sale because many people are living in homes with a very low rate mortgage that they can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and very low transaction rate. That actually pushes up prices of other existing homes and also of new homes because there's just not enough supply. The builders are busy, but they're running into all kinds of supply issues still around
Target filled.
zoning and workers and things like that. So it's quite challenging. And of course, rates are high. So people who are buying, a lot of the buyers are cash buyers or are able to actually pay without a mortgage because mortgages are expensive. I will say the first problem, the longer run problem of supply, is a longer run problem. The other problem associated with low rate mortgages and high rates and all that, those will abate as the economy normalizes and as rates normalize. But we'll still be left with a housing market nationally where there's a housing shortage.
There's no question we have a supply issue, and this issue of high prices, lack of supply, of course, disproportionately impacts some communities more than others. According to the Monetary Policy Report, the employment rate for the black prime age labor force, that is persons between 25 and 54 years of age, reached a historical peak in 2023. The gap between black and white prime age employment dropped to a nearly 50-year low at around 3%. We can appreciate progress, but a 3% gap is still significant. Would you agree that it is important to continue focusing on narrowing this gap? And if so, what tools does the Federal Reserve have to do this work?
It's very important, and the single best thing we can do is get prices under control, get inflation under control, so that we can have a long expansion with, the record is clear that a long expansion really gives significant benefits to people at the low end of the income spectrum because the labor market gets very tight, inflation is low, and they benefit more than anybody. So that's where we were before the pandemic, and we'd like to get back to that place.
Thank you so very much. I think there are some other legislative tools that Congress could use, and I'm happy to continue to work with the chair in the ways that we've already done to improve that difference. Thank you.
For sure. Thank you, Senator Warnock. Senator Lamas from Wyoming is recognized.
Thank you, Mr. Chairman. Welcome. It's nice to see you, Mr. Powell. My first question is about CDBCs. There's been some chatter lately on the social media that people are concerned about the Fed creating a CDBC without legislative authorization. You and I have discussed that before, and as you know, there are other means other than a CDBC that could use digital assets to create a secure and instant payment system other than a CDBC. So the question is this: do you still agree that the Federal Reserve cannot introduce a U.S. central bank digital currency without congressional authorization?
Yes, I do.
Thank you. That's really calms people's fears, the people who are concerned that we could end up with something like the digital yuan that is used as a means of surveillance. So I think that will calm some of those discussions down. Thank you so much. My next question is about your core CPE. Now, as you know, there's a disconnect between how you measure inflation and how the American people see inflation, because the American people are spending their money on gasoline and food and rent, things that have gone up a lot. And they hear about these improvements in the economy that they're not seeing in their everyday lives. So can you explain what measures you use to evaluate inflation, and just explain to the American people why you don't factor in the things they spend money on every day, like food and gasoline?
Actually, we do. Our statutory target is inflation. It's not core inflation. So, and if you look at headline inflation over the last 12 months, that's it. That's our goal. It's 2.4%. Core inflation is actually higher than that. It's 2.8%.
Yeah, there's
the
not
reason
much
is that
going on.
some energy and food
We're
prices
getting
have come
another 9,
down,
10 minutes.
and those
Probably
don't
not
count
gonna
in
find
core.
anything.
So we, our overall
I'm just
legal
gonna step
target
out.
is
We're gonna close
headline
the
inflation,
stream
which
for
is,
today.
and
tomorrow
it's
we'll get
our
some more.
best
Maybe
effort to
on
capture
Power Hour this
the
afternoon,
cost of
3 to
living
4.
that
we'll,
people face. It's not perfect.
do
It's very,
something.
you have to make all kinds of judgments that aren't easy. I mentioned that the housing earlier. How do you measure housing inflation? Lots of issues, but that's what we target. The reason we look at core, though, is that headline inflation tends to be more volatile, and it tends to be pushed around by commodity prices, which really don't relate to the overall state of the economy. Is it tight? Is it loose? So core tends to be a better predictor of overall inflation than overall inflation is. I know that's complicated, but ultimately, though, our target is headline inflation, which does include food and energy.
Mr. Chairman, I'd like to include a letter in the record that Senator Tillis and I and 2 Democrats on this committee have submitted with regard to Basel III. My question...
Without objection.
Thank you very much. My question is this: what do you think is more likely, that it will be harder for consumers to buy a house and small business to obtain a loan under Basel III, or will lending just migrate outside the banking system, which may be harder to assess because it's opaque?
I'm sorry, I didn't get your question. I apologize.
Okay, so with regard to Basel III,
Yeah.
If there are more constraints on lending activity, what is more apt to be the consequence of that? That it's harder for consumers to buy a house or a small business to get a loan, or that lending just migrates outside of the traditional banking system?
So if there were anything that constricted credit in the banking system, they would probably be both things. Probably there'd be fewer loans made, but in addition, there would be non-bank lenders that are more than happy to make that loan.
I have a chicken and the egg question here. Starting with TARP in 2008, there has been a very aggressive printing of U.S. dollars up until today, and it particularly went on hyperdrive during that 22-month period of COVID. So my question is, which comes first? Congress spending more, and so you respond by printing more money, or are they separate considerations?
I think it's hard to get my mind around that question. We don't print money to fund the deficit. That's not what happens. But when the government borrows, it issues, basically the government borrows to fund deficits is what happens.
Right. And so so that would indicate to me that you do respond, because we, in deficit spending, are creating a demand to borrow, and you're responding by...
Well, we're not making loans, though. You know, we're not lending money to the government. We're not financing these deficits.
And so there's no chicken and the egg relationship?
There's not really, no. I'd have to think about this. I got to think about the way the plumbing. Why don't we continue this?
Yeah, I'd love to. And your thoughts earlier about fiscal sustainability and how we can work with you and bipartisan, maybe next year, to address these issues. You know, when you say things, you have to be careful because what you say has ripple effects outside of this building. But it would sure be nice if we could sit down with you on a bipartisan basis and have those discussions in a frank way.
Thank you, Senator Lummis. Senator Fetterman of Pennsylvania is recognized. All right, Senator Van Hollen of Maryland is recognized.
Let me,
All right,
No, let
back,
me start
not
by
much going
thanking
on.
Senator
Market
Fetterman,
just wants to rip higher.
allowing me
Too hard to
Mr.
buy,
Chairman,
too
good
hard to
see you.
sell.
Real wages are
Just,
up, right? That's good news.
We're just gonna end stream here for
Yes,
today.
over the last couple of years, wages have been going up more than inflation. Real wages broadly are up.
That means more families have more spending power in their budgets, right?
Yes.
Worker productivity's up, right?
Yes, it is.
Corporate profits are up, right?
I believe so.
And worker productivity is rising faster than corporate profits, right?
I don't know the answer to that. That may well be right.
The charts I show suggest that. So that would indicate that unless, corporations decide to pocket as profits more of the gains they get from their workers' labor, that we should be able to continue to have increases in real wages. Is that right?
Yeah.
And so it's important, I think, that, people recognize that these corporations are doing better than ever.
All right, guys, hit the like button,
They are
subscribe.
deciding
We'll see you
now
guys
to
later on the next
essentially
trading day.
return the gains
Not
made
much going
through
on
their
today.
workers' productivity, which is going up.
If you buy it, if you
Or
bought it
to
at the
shareholders,
opening,
obviously
and then
shareholders are going to get a profit. But the question
be,
is whether or not
up now. We did a trade, it was good.
share in that profit.
We're
to
just
the extent of
not
their
finding
worker
any more
productivity.
opportunities at the
And
moment.
as you know,
so
we've seen a great
we'll just
gap
wanna wait.
over decades.
We just wanna get out.
Between rising worker productivity and real wages, and we're hoping to close that gap. Would you agree that?
All right, I'll see you guys later.